crazy to look at with 3D glasses.
They're amazing to look at with 3D glasses. Nice billionaires and those two-tone lobsters. History is riddled with unexplained events. You can turn back now or learn the stuff they don't want you to know. Okay, well, the 1% don't pay taxes the way that you do. Not really. Not the same way an ordinary person would. And in another way, you could say they do. It's a financial pickle. You know, it's a paradoxical statement at times. What you have to understand from the jump is that very, very wealthy people look at money in a very different way. To many of the very wealthy people in the world today, money is a tool simply used to generate more wealth. As such, you want to maximize the effectiveness of that tool. You know what I mean? Keep it in good working order. And anything that goes against the effectiveness of your pre-existing wealth or value or money is therefore anathema to your position. In most cases, there are cases of people who feel ideologically compelled to spend their money making the world a better place instead of making themselves more money. But unfortunately, they're kind of rare. You know, they're like the lobsters that are half blue and half red. They exist, but it's sort of big news when you find one. So anyhow, here's the pickle.
They're crazy to look at with 3D glasses.
They're amazing to look at with 3D glasses. Nice billionaires and those two-tone lobsters. But here's the thing, Matt, you foreshadowed it beautifully. In this country, the taxation looks at a few things in a very different light. Income from work. You know, if you have a job or a career that generates hourly wages, you have a fixed salary, you have like a commission rate, stuff like that, that is taxed differently than income from wealth. And the vast majority, virtually all of the top 1% or 0.1% people that you hear talked about in the news, virtually all of their money comes from wealth, not their actual job if they have one. Their income is from assets, stock holdings, property, fine art, moving across the world in free ports or other investments. And so what that means, like let's say you own like $250 million worth of some very cool stock, Dave and Buster's, whatever. The stock goes up. The value of the pieces in your art collection get more expensive because somebody in Vanity Fair or Paris Review wrote a cool think piece about Basquiat or what have you. The real estate market shifts in your favor. Then that means your wealth increases too. And you didn't really do anything except maybe ask the editor of Paris Review to greenlight that Basquiat piece in exchange for a donation to, you know, a foundation that you're both on the board of, et cetera, et cetera.
Well, and it's weird to think about because that wealth, while on paper, is amazing and huge. And so, oh my God, I'm so rich. Look at my wealth. That money sits in places like stocks and bonds and other things that aren't tangible. You can't actually pay for anything with those. But our system is built to where you can sell off, let's say, a small amount of stock or even a hefty amount of stock that doesn't fully reduce that wealth bubble you've generated, but gives you enough liquid income, actual cash to function on. You'd think, well, okay, that money that comes through, that would be treated the same way as income. But no, in our country, that's treated in a completely different way. And that is pretty baffling to me, just that fact alone.
It's a convenient law, you know, or it's a convenient policy and process that certainly benefits the very well-to-do. There's a person we want to introduce, Che-Ching Huang, who is the executive director of the Tax Law Center over at the NYU School of Law. And Huang points out that income is only subject to taxation if these people who own these assets sell the asset. On the way out, it can get taxed. And this can mean that people who are of high net worth can choose whether they pay taxes on the growth of their wealth. And if you look at specific examples, it gets even weirder. That 37%, that highest tax rate, all right, right now, that applies to individuals who are making a little more than $500,000 a year, and for married couples making a little more than 620 something $1,000 a year. If you want to avoid the tax rate in that income bracket, here's the easy move for you. Just give yourself a crappy salary. It works every time. You know what I mean? Also, it looks really good if your PR folks are on the ball. They'll be like, this CEO refuses to take more than $1 in salary until they get those stock prices back up and until employee demands are met. Just $1. Yeah. How does he do it? What a hero.
Well, it's why you'll commonly see in the Fortune 500 companies CEOs who make about $400,000 a year on paper. And then the rest of their income is all in stock options. And that's why we recently on this show talked about the trend of paying CEOs in stock options and why that's become such a big deal and why they make so much ungodly amounts of money in stock options, but specifically in that way.
Well, so that means that they're paying less income tax on their salary, but they're still paying capital gains taxes, right?
If they sell their stock.
If they sell their stock. So it's like, you know, when Elon Musk, you know, just bought, collected the financing to buy Twitter, he was not liquid in nearly, 40 billion to the tune of $40 billion. So he had to get loans that he leveraged against his holdings without actually having to liquidate, which is another superpower of the ultra rich.
Right, which we'll get to in just a moment. To stay on the salary thing here, Jeff Bezos, you know him, he collected something like 79 to 80 grand in salary as a CEO of Amazon. That was on purpose. That's not making or breaking his bank. His light bill is going to be fine. And then we see a laundry list, a cavalcade of corporate Goliaths. People like Steve Jobs, people like Meg Whitman from Hewlett Packard, the co-founders of Google, Sergey and Larry, and of course, Mark Zuckerberg. They have all at some point taken a salary of literally $1 per year because this is a smart, rational move from their perspective, and it works, and it's also not illegal. Yet, usually on the left of the political bell curve, who try to adjust this, like Elizabeth Warren and Bernie Sanders in 2020, they both had their wealth tax proposals, which very simply says we want to find a way to make it such that income from wealth or assets is taken into account kind of the same way income from work is taken into account. But wealth and income, two very different things. One great example, let's say you're a new hotshot surgeon. You're very good. You come out of your residency and you are making instantly $400,000 a year, since we brought that number up earlier. But you are a self-made person. You don't have generational wealth hidden, and you have like $500,000 in student loans. It's going to take a while for your wealth to, like, for your income to transform into wealth, even if you're savvy with investments and whatnot. So there's a huge difference. And a lot of people who become very, very wealthy, who become billionaires, they are profiting from the work one of their ancestors did.